This is Bryan Rich from Money and Markets TV. Seems like the conventional wisdom in the global markets right now is that the Federal Reserve's easy money policies mean higher asset prices into perpetuity. It's that reasoning that emboldens speculators to push markets higher and higher, expecting a free ride, and it gives asset managers an excuse to keep plowing money into markets with less and less respect for risk. And it creates this self-fulfilling market response. But the world's problems are complex, and complex problems don't tend to have such neat and simple answers. In the end, the market activity of recent months is just a lot of money leaning heavily one way, without the fundamentals to support it. And if history is any indication, it sounds like another formula for boom and bust. In this case, the boom was in commodities and other contra-dollar assets. So now we have to ask, is another bust in the making? Historically, a massive financial crisis like the one we saw 3 years ago is followed by a long, painful recovery, and one littered with economic shocks. But global investors seem to think we're in the middle of a legitimate recovery phase, not one that remains dependent on government life support. They're less concerned with creating real economic growth and more concerned about slashing deficits and hiking interest rates. This type of mindset supports asset prices, which in turn convinces investors that markets are healthy, sending prices even higher. It's exactly the type of market that legendary hedge fund manager Paul Tudor Jones calls the last third of a move. And in that type of market, he said that irrationality reigns supreme. Nowhere has that irrationality been more evident than in silver prices. The silver market had a parabolic move in recent months, but this past week, the CME responded to the dangerously high prices and buildup of fearless speculators by hiking margin rates. They did so 3 times in 5 days, and brokers hiked even further, all trying to reduce their risk from a crash in silver prices. But those moves ended up producing the very crash that they were trying to avoid. During the rally, we heard a lot of talk about real money diversifying into silver. But when the skirt was lifted, when margins were increased, we saw that it was a market littered with speculators. After testing its all-time high reached back in 1979, silver fell nearly 30% in 5 days. It reminded me of the top in the oil market in 2008. Then, as now, margin rates were increased. Speculators were squeezed, and the market collapsed. Crude ultimately fell from $147 a barrel all the way down to $30. Now, silver saw the biggest drop last week, but gold and oil, the other popular hard currency trades, fell too. So, what about the most popular anti-dollar trade, the euro? Now it's declining as well, fueling an aggressive bounce in the dollar. Contrary to popular opinion, I think the dollar is in position to have a major rally ahead. The US currency has moved in roughly 7-year cycles for the last 4 decades. We're 3 years into the current bull cycle, and the dollar is up only about 4% during that time. And that pales in comparison to the major broad dollar moves in the other historical dollar cycles. So if the dollar index remains above its March 2008 low, it has the potential for a huge run. If it breaks below that level, it would invalidate 40 years of cycles and the end of the dollar bull market. But for now, the cycles and the likely bust taking place in contra-dollar assets favor the buck. Sure, many investors view this as a contrarian trade, but for those people, my advice is to close your eyes, pinch your nose, and buy the dollar. I'm Bryan Rich from Money and Markets TV. Thanks for watching.